Usually when we talk about a mathematical absolute, there's this expectation of clean, undeniable precision.
Right, like gravity.
Exactly. You drop an apple, it falls to the ground. There is no gray area there.
Yeah, it's a binary outcome, and it happens or it doesn't.
But then you step into the world of prediction markets, and suddenly, well, that precision gets entirely warped. We are looking at a landscape today that is supposed to be the ultimate gauge of reality.
Or at least that is the promise, right?
Right. I mean, during the 2024 U.S. elections, a platform called Polymarket saw over $3.7 billion in trading volume.
Which is staggering.
It is massive, and major news outlets were citing its odds on a daily basis, calling it like the ultimate truth engine of public sentiment.
Yeah, the underlying logic there was that if millions of people have their own actual money on the line, well, the aggregated odds must reflect the most accurate probability of an event actually happening. It is basically the absolute pinnacle of the wisdom of the crowd theory.
Yeah.
We just assume a market of that size with that much capital is perfectly rational.
Yet we have our hands on a fascinating academic paper today. It's titled Unravelling the Probabilistic Forest, Arbitrage in Prediction Markets.
Authored by researchers from IMDEA Networks and the Oxford Internet Institute.
Right. And they took a microscope to the blockchain data powering this massive platform. And it turns out that so-called truth engine frequently breaks down.
The math actually glitches.
Yes. And when it glitches, sophisticated traders and increasingly AI algorithms are pulling guaranteed risk-free profit right out of thin air. Okay, let's unpack this.
Let's do it.
Before we can dive into how people are extracting millions of dollars from a simple math error, we really need to understand the basic mechanics of how Polymarket actually operates and, the fundamental rule of reality that it relies on.
So on Polymarket, users are not buying stocks in a company. They are buying shares in the outcome of a future event. And these are categorized into topics like politics, sports, crypto, and culture. Every event is posed as a question with specific conditions. So, for example, will Team A defeat Team B? And you can buy a YS token or a NO token.
Got it.
The price of that token is directly tied to the market's perceived probability of that event happening.
Meaning, if a YS token costs 60 cents, the market is essentially saying there's a 60% chance that outcome happens.
Exactly.
And if it resolves as true, that token pays out exactly $1.
Right, which introduces a fundamental rule of probability. To ensure a market can properly resolve, the set of conditions has to be exhaustive.
Exhaustive meaning it covers all possible outcomes.
Yes, and it must be mutually exclusive, meaning only one condition can actually happen.
Let me put it this way for you listening. Think of the market like a pizza.
Okay, a pizza. I like that.
Right. So if you have a sports match, the outcomes might be Team A wins, Team B wins, or they tie.
Those are the only possible outcomes.
Yeah, those are the only outcomes. So if you add up the market probabilities, like the prices of the YS tokens for all three of those outcomes, it absolutely must equal exactly 100%, or $1, one whole pizza.
Yeah. Right.
You cannot have 110% of a pizza. And you definitely cannot have 80% of a pizza. The slices have to make up one whole pie.
And in traditional finance, if the prices deviate from that whole pizza, market makers instantaneously correct it.
They just snap it back.
Exactly. But the researchers found that on Polymarket, the math frequently fails. This is the first type of glitch they identified, known as market rebalancing arbitrage.
Okay, so what does that actually look like?
Well, the researchers found actual situations where you could buy both the YS token and the NO token for a single event for less than $1 combined.
Wait, really? Think about that. You are buying both sides of a coin flip, and it is costing you, say, 85 cents.
Yes.
But no matter what happens, the market pays out $1 to the winning token.
Right.
So you just locked in a guaranteed 15-cent profit, completely risk-free.
Completely. And they call that long arbitrage. But the inverse is true as well, which is short arbitrage.
Okay.
Sometimes the sum of the YES probabilities exceeds $1, say a pizza that adds up to $1.20.
Right, too much pizza.
Exactly. In that case, the NO tokens are undervalued, and a trader can exploit that by shorting the market.
See, I have to push back here.
Sure.
In the year 2024, with automated trading algorithms and supercomputers, how is it possible that a platform handling billions of dollars just leaves free money sitting on the table?
It sounds crazy, I know.
I mean, I use standard brokerage apps. When I hit buy, the trade happens. Why doesn't this system just automatically correct the price of the pizza?
The answer lies in the architecture of the platform itself. Unlike Wall Street, where a single central server processes trades instantaneously, Polymarket operates on a blockchain,
Yeah.
specifically the Polygon network,
Right.
and
Okay.
it uses a decentralized central limit order book, or a CLO.
Stop right there. What exactly is a central limit order book, and how does it differ from me just buying a stock normally?
Well, in a traditional brokerage, your broker usually routes your order to a massive market maker who instantly fulfills it from their own inventory.
Okay.
A central limit order book is essentially just a giant public digital bulletin board. Buyers pin up notes saying, I want to buy at this price. Sellers pin up notes saying, I will sell at this
Oh,
price.
I see.
The system matches them peer-to-peer. And on a blockchain, placing those notes and matching them requires network consensus,
Which introduces latency.
crucial latency. Trades on this decentralized bulletin board are what we call non-atomic.
Non-atomic. Okay, explain that.
In traditional finance, an arbitrage trade is atomic. Buying the undervalued asset and selling the overvalued asset happens simultaneously. If one part fails, the whole trade aborts. There is zero risk.
Gotcha.
But on Polymarket, placing multiple orders in the order book carries execution risk. You might successfully buy the cheap YLS token, but before your order for the NO token goes through the blockchain, someone else buys it, or the price shifts.
So it's kind of like trying to buy the exact same concert ticket on two different devices over a really laggy Wi-Fi network.
That is exactly what it's like.
You might click purchase on your laptop and your phone at the exact same time, but the network processes one request a fraction of a second faster.
Right.
The first ticket goes through, but by the time the second request hits the server, the seat is gone.
That is the perfect analogy.
Yeah.
Because these trades have to be registered on-chain and because users are matching bids dynamically across a distributed network, there is volatility.
Yeah.
These non-atomic trades create temporary blind spots. The probabilities misalign for brief windows because the system simply cannot force an instant simultaneous correction across all related tokens.
So if the blockchain is creating these micro delays on single, simple bets, what happens when the bets are connected?
Ooh, that's where it gets complicated.
Because finding a math error in a single question, just waiting for YS and NO to dip below $1, seems pretty straightforward. But you don't extract millions from just waiting on a single coin flip.
No, you don't. And this is the second form of arbitrage the study uncovers, called combinatorial arbitrage, or intermarket arbitrage.
Okay.
This is where the math error isn't isolated to one question. It is scattered across completely different but logically dependent questions.
Like a web.
Yes. It involves building a portfolio of bets across multiple different markets, where the logical overlap guarantees that at least one of your bets will win.
Walk me through an example of how outcomes are tethered to each other.
Well, the researchers point to sports as a baseline. Imagine two separate markets. Market X asks, will Team A win the match?
Okay.
Market Y asks, will Team A win by at least 2 goals?
Right, I follow.
If Team A wins by 2 goals, they inherently also win the match. If the market prices Team A winning by 2 goals higher than Team A winning the match, that is a logical paradox.
Because the subset cannot be more probable than the whole.
Exactly. An arbitrager can buy specific combinations of YES and NO tokens across both markets to lock in a guaranteed profit based on that contradiction.
I have to imagine this gets incredibly messy when you apply it to politics.
Oh, absolutely.
You can calculate the exact odds of a soccer score, but human elections have infinite chaotic variables. And the source material highlights that the 2024 U.S. elections were the primary battleground for this.
The sheer volume of political markets created massive overlapping dependencies.
Yeah.
To illustrate the data impartially, let's look at the actual markets that were tracked. You had one market asking if Donald Trump would win the presidency.
Okay.
A completely separate market asked if Trump would win Pennsylvania. Another market asked if Kamala Harris would win the popular vote. Another asked about her winning the Electoral College.
Oh, okay.
You even had markets earlier in the cycle regarding Vivek Ramaswamy winning specific state primaries versus dropping out of the race.
All of those are distinct betting pools, but they are completely intertwined in reality.
Deeply intertwined.
Right, because if a candidate's odds of winning the presidency are sitting at 60%, but their odds of winning a critical swing state that they historically must carry to win the presidency are sitting at like 45%, well, there is a mathematical misalignment there.
A massive one.
Yeah.
The problem is the source material notes there were over 17,218 different conditions across these markets.
Wait, 17,000? How could anyone possibly scale the search for these complex dependencies?
It's nearly impossible for a human.
I mean, yeah. You can't just stare at a spreadsheet of 17,000 ambiguously phrased political questions and spot the overlapping math errors in real time.
That was the major technical hurdle for the researchers. And it is the same hurdle for traders. So to solve it, the researchers turned to AI.
Of course they did.
They used large language models, specifically Mistral and DeepSeek R1, to map the semantic dependencies between these markets. They effectively built an AI arbitrage detective.
I am highly skeptical of this. We see AI hallucinate basic facts all the time.
Sure.
Can an LLM actually grasp human political nuance well enough to risk real money on it?
Well, the study details some severe limitations. It turns out AI actually struggles deeply with this kind of logic. You have to remember that large language models are essentially highly advanced autocomplete engines.
Right, predicting the next word.
Exactly. They predict the next word based on probability. They do not possess actual common sense. When the researchers fed the LLM a market with too many conditions, the AI's context window, which is essentially its short-term working memory, filled up entirely.
It just lost the thread of the conversation.
Completely. The AI would get stuck in endless logical loops. Its reasoning broke down because it couldn't hold the mathematical dependencies of 20 different political outcomes at the same time.
So what did they do?
The researchers actually had to mathematically cap the conditions at 4 and then create a fifth OR catch-all condition just to keep the AI from short-circuiting.
Did anything else trip it up besides the sheer volume of variables?
Ambiguous human phrasing was a massive barrier. For example, a market might ask, will a specific candidate win by the largest margin?
Okay.
The AI could not process it because the human author didn't specify who the opponent was.
Ah, I see.
Or a market asking about a candidate flipping a specific state. The AI gets confused by the historical context required to know what the word flipping implies mathematically.
Because it doesn't know who won it last time unless you explicitly tell it.
Right. What's fascinating here is that we are using these cutting-edge, massive language models with billions of parameters to parse fragmented, noisy, and often poorly phrased human logic, just to find simple mathematical dependencies.
It's why
We are using the most advanced computing on Earth just to figure out if the pizza slices add up to more than a whole pie.
Okay, so we know the glitches exist. We know they happen because of decentralized blockchain latency. And we know you need heavily modified AI to map the really complex ones.
Yes.
The question for you listening right now is, did anyone actually spot these opportunities in the wild and take the money?
Well, the researchers analyzed historical bid data from April 2024 to April 2025. They parsed over 86 million executed bids on the Polygon blockchain to see if these theoretical glitches were actively being exploited.
Here's where it gets really interesting.
They found that roughly $40 million in profit was extracted through these exact arbitrage strategies.
$40 million extracted from the quote-unquote truth engine.
Yep.
I want to highlight a specific anecdote from the data that just perfectly illustrates the scale of this. There is a user account publicly logged on the blockchain under the handle at Tuta91.
Oh, yes. That case study is a perfect example of extreme market dislocation.
This user found a market experiencing a real-world discount glitch. They managed to purchase both a YS token and an NO token for the exact same condition for less than 2 cents each.
Let's break down that math so the mechanism is really clear.
Yeah.
They spent less than 4 cents combined to acquire both sides of the outcome.
Right.
That guarantees a payout of $1 upon resolution.
And they didn't just do it once. They recognized the system was lagging, so they bought up the available liquidity in that glitch window over and over again.
They just hammered it.
They walked away with an instant profit of $58,983.36 on a single trade window.
Incredible.
All because the market temporarily detached from reality and couldn't update its own prices fast enough.
And while that is an extreme outlier born from a panic or a severe lag spike, it highlights the sheer inefficiency that can occur in decentralized order books.
Definitely.
But what I found even more compelling in the data wasn't just the complex AI-driven combinatorial arbitrage. It was the success of a surprisingly simple strategy the researchers uncovered.
Ah, the buy and O phenomenon.
Yes. The researchers tracked the profitability of different trading behaviors across those 86 million bids. They found that simply buying NO tokens across the board yielded over $17 million in profit for traders.
Just systematically betting against things happening. If you don't even look at the question and just buy NO, you make millions. Why is that so consistently profitable?
It comes down to human psychology. In prediction markets, users consistently overvalue long-shot YES bets.
Like what?
People naturally want to bet on the unlikely, exciting outcome. It is the lottery ticket mentality. The researchers noted examples like users buying shares on Kanye West winning the election.
Oh, wow.
Logically, the probability of that event approaches absolute zero. But because people are willing to throw a few cents at a crazy what if,
Yeah.
it props up the price of the YES token to maybe 2 or 3 cents.
Which means the NO token, which should technically be priced at basically 99.9 cents, gets discounted to like 97 cents.
Exactly. The human desire for a lottery ticket creates a highly profitable premium for logical, emotionless traders or automated bots who simply step in and buy NO.
They just collect the premium.
Yeah, they're essentially getting paid a few cents on the dollar to provide a reality check to the market's irrational exuberance.
But you might be thinking, why should I care if a crypto bot makes a few grand off someone betting on Kanye West?
Right. Fair question.
If you aren't trading on Polymarket, why does this hidden math heist matter to your daily life?
If we connect this to the bigger picture, it fundamentally changes how we interact with data in the modern media landscape.
How so?
Well, at the beginning of our deep dive, we mentioned that major news outlets are using these platforms as barometers for reality. They report these odds as the definitive probabilistic truth.
Right. The headline says, the market predicts a 70% chance of an interest rate cut. You read that headline and assume 70% is the natural, pure consensus of humanity.
What this research shows is that those odds are not naturally perfect. They are often incredibly flawed due to blockchain lag and human irrationality. Arbitrage in this ecosystem is actually a positive sum force.
Wait, positive sum.
Yes.
Usually when someone extracts $40 million from a system, we think of it as a negative, like they skimmed it off the top.
In traditional terms, yes. But here, these arbitrageurs are acting as an essential corrective mechanism. Without them exploiting these gaps, the asset prices wouldn't align with the underlying probabilistic truth.
Ah, I see.
If the pizza adds up to $1.20, the percentages are completely wrong. The public is being fed incorrect data.
So by taking the free money, the arbitrageurs force the prices back to exactly $1.
Exactly.
The greed of the traders is what forces the market to be rational.
When you check a prediction market to gauge reality, or when you read a news article citing those odds, you are entirely reliant on these unseen, profit-seeking arbitrageurs to keep the math honest.
That's a wild thought.
The accuracy of the truth engine requires an enormous amount of unseen labor, both human and artificial, just to maintain the illusion of a perfectly rational crowd.
So what does this all mean? Let's recap what we have uncovered today. We started with a basic, undeniable rule of probability. The exhaustive outcomes of an event must equal 100%.
The whole pizza.
Right. And we uncovered how the transition to decentralized central limit order books creates non-atomic trades. That blockchain latency results in micro delays, blind spots, and risk-free profits.
And we explored how researchers are pushing the limits of large language models, navigating context windows and logical loops to map complex, fragmented human dependencies across thousands of political markets.
We revealed the sheer scale of this phenomenon. A $40 million hidden economy of traders and bots pulling profit out of the system, which paradoxically is the very mechanism keeping our public prediction platforms honest.
It is a delicate, chaotic, and incredibly lucrative ecosystem.
I want to leave you with a final thought to mull over. We have seen that currently heavily modified LLMs are required to detect these complex combinatorial arbitrage opportunities.
Right.
And we know that automated bots are increasingly the ones executing the trades to fix the math.
Yeah, humans can't keep up.
So if the AI is finding the errors, and the AI bots are trading the errors to correct the market, what happens to the human wisdom of the crowd in the near future?
That is the big question.
Will these massive prediction markets stop reflecting human sentiment altogether? Could they simply become a digital battleground where different AI algorithms trade against each other at the speed of light, while we just sit back and read the headlines they generate?
It certainly raises profound questions about what public sentiment will even mean when the market is entirely curated by algorithms.
Thank you for joining us on this deep dive. The next time you see a news headline citing betting odds on the economy, technology, or an upcoming election, remember the invisible mathematical war being fought in the background just to keep those odds remotely accurate. Keep questioning the numbers you see in the news.